Good morning and welcome to this Monday, July 19th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it is the Monday after options expired, never a good thing. It's also after July 17th, which begins our most bearish historical period of the year. And we know that the 19th to the 25th of all calendar months tends to be the weak link for the stock market. And it's July 19th. That's right in the middle of all of those things. So I'm not shocked waking up to futures today, which are now showing the Dow Jones Industrial Average down close to 500 points. Was just over 500 last time I looked, I think 475. So it looks like it's going to be off to a rough start. NASDAQ not getting quite hit quite as hard on a relative basis, but it too is down almost 1% in pre-market. So it looks like we're going to get off to a rough start after a pretty rough end of last week. I think the overall market, the major indices really masked some of the weakness, a lot of the weakness from last week. Because it was the high market cap stocks that really held up best. Stocks like Apple, Microsoft, Google, and so forth. They were hit. They came down a little bit, but really not much. And so looking at the spider, looking at the QQQ, you would think, okay, we're not really getting hit that hard. But when you get beyond that top level of stocks, last week was a pretty bad week. And I wouldn't be surprised to see this choppiness, maybe even outright weakness, continue here for a bit. There are warning signs, not for the longer term. I'm still very bullish going further out. But in the short term, you've got to be careful when the 10-year Treasury yield continues to drop because it's telling us money's going into Treasuries. We also saw last week that the leaders, the only groups really that performed halfway decent were the defensive groups. So we had utilities and consumer staples, real estate, so forth doing well. But anyway, we'll get into all that in just a minute. Let me go ahead and take you over to Earnings Beats for those of you that are new to us at Earnings Beats. Love to have you join our free Earnings Beats Digest, become part of our community. That is an article or a newsletter that I publish, just a brief article 3 times a week, Mondays, Wednesdays, and Fridays, out in the morning before the market opens. This is completely free, no credit card required. You can unsubscribe at any time. All you need to do is type in your name, email address on our homepage in the space provided. Hit that subscribe button. We'll make sure you get set up. Yeah, I mean, it's a very educational newsletter. I try to make it educational, looking at some of the things we look at Earnings Beats. So usually it's talking about relative strength. This morning I put an article in there on Intel. Let me show you the chart on Intel right now and kind of give you an idea of some of the things that we talk about in this newsletter. So Intel, when you're just looking at the chart here, you see a move up, a pullback, sideways consolidation. This is great, but this doesn't tell you the whole story. It looks like it's, maybe not one of the best stocks, but it does look like at least went up, set a new high, pulled back. Maybe it's not that bad. But then you look at the accumulation distribution line, you see that down at a low. And then when I go into the relative strength, and this is one of the things I really like to get into, if you look at Intel relative to semiconductors, we just hit a 52-week low. So it's one of the worst performing stocks among semiconductors. That should tell us something. Intel reports earnings on Thursday. Now, I don't expect the earnings to be horrible, but what this is telling me is that Wall Street is saying, be careful with Intel. Intel is not trading nearly as strongly as other stocks within this space. Even AMD, which was lagging for a while, started to come back a little bit. And you've got other leaders like NVIDIA, which was hit pretty hard last week, in my opinion, because of options. I'll talk about that in just a few minutes. Applied Materials, these are companies that, they got hit last week, but they've been strong performers on a relative basis. So those are the companies that Wall Street's placing their bets on, not Intel. Now, does that mean Intel can't go higher? Of course not. All stocks find a bottom at some point. But what this is telling me when I look at the chart is I don't think there's a whole lot of accumulation going on in Wall Street's world. So I would be hesitant. I'd be a little careful going into their earnings report. It could be a, sell on rumor, buy on news kind of a situation where maybe Intel does get a little pop after earnings, but I wouldn't want to take that chance. Just the way I approach the market. So let's see, what else do we want to talk about? Well, let's get into the some of the action. I didn't get the screen set up this morning the way I normally do with the top or the 10 groups, but I just wanted to take a look at this the homepage or the dashboard over at Stock Charts, and you just get a sense real quick of the red that took place on Friday and throughout last week, especially after options. We had our Max Payne options webinar last Tuesday. Just saw market pulling back. Now you look and you see the Dow, NASDAQ, and S&P all down roughly 0.75% or so. But look at the small caps and the mid caps. And I want to pull up the S&P 500. I'm going to show you a weekly chart. So if we pull up the weekly chart here, a couple of things that I think are worth noting. Number one, really didn't look like it was all that bad a week. We only lost, roughly 1%, which was almost what we lost on Friday. So it really didn't seem like a horrible week. But we do have higher prices and a lower PPO. And this is occurring up above the 4 level on a weekly chart. Now you can see the PPO. This is as high as it's been the last 5 years, and we could stretch this out. And you can see here's the 10-year chart. And when you look at that PPO, it's the only time we got above 4. Now, granted, we did come from a low level. We had the pandemic. And just like the pandemic is affecting all kinds of different things, prices and lumber, and, you've got this whole demand supply imbalance because of the pandemic. Nobody wanted anything. And now you're coming out of the pandemic and everybody wants everything and nobody's got anything. So in a kind of a very general sense, that's kind of how I would explain the market. Just there was no demand and everybody had supply, and then everybody stopped working for a while. Supply went down, then the demand came back, and all of a sudden there's nothing out there. But when you look at technicals also can be impacted. They're just formulas. So when you get this huge drop and then all of a sudden you make this big move, you think that, hey, we've made a huge move off the bottom, which we did. But if we'd never had this pandemic, if we just kind of whited out these 2 or 3 months here and just looked at the chart going across, it wouldn't, it just looks like a nice uptrend. But because we were coming off of such deflated levels, the PPO on this rise back to the upside did move quite a bit higher over the period of time, and that had an impact on the PPO. But having said all that, we still have, hold on one second. Okay, so we still have this PPO that's rolling over with prices moving higher. So we've got a negative divergence on a weekly chart. Now, if you get a negative divergence on an hourly chart, you can take care of that over maybe the course of 1 to 3 days. We could see that hourly PPO move back to the center line, or we could see prices just keep moving up and the negative divergence eliminated. Sorry. If you look at a daily chart and you've got a negative divergence, it could be maybe 1 to 3 weeks is kind of what I look for to hopefully resolve the negative divergence, or prices could just keep going up. You can eliminate a negative divergence. It's not a guarantee that you're going to go lower. But when you get to a weekly chart and you start seeing negative divergences on the weekly chart, now you're talking about probably 1 to 3 months to try to correct that negative divergence. Now, I want to go back and just point you to 2013, 2014, 2015, where that weekly PPO kept going lower and lower and lower, and prices, for the most part, just kept going higher and higher and higher. So And I point this out because negative divergences are no guarantee. There's nothing in technical analysis that's a guarantee. What it tells us is maybe we need to be a little bit more cautious, whatever that means for you, maybe more cash, maybe just hedging. It is summertime. I mean, you got to take everything into account. Negative divergence on a weekly chart in July means a lot different to me than a negative divergence on a weekly chart in November. Just because historically I know November is very strong, November, December, January. And so I wouldn't place as much emphasis on a negative divergence in November as I would in July. And so as we keep moving higher here and this negative divergence develops, this is something that we need to be at least somewhat concerned about. So just keep that in mind, that I think we're a big picture bull market, secular bull market. We're going higher, my opinion. Short term, maybe even intermediate term over the summer, there are signs that we have to be aware of. Long-term investor, I would just kind of put my blinders on, hold for the long term. I wouldn't change a thing. Short-term investors or traders, it could be a much different animal. If you keep trying to trade the market now the way it was 2 months ago or 6 months ago or even a year ago when we were coming out of the pandemic, we're at a different place technically. We're at a different place historically, seasonally. So I think it's worthwhile to at least consider that we could be in for a very choppy period. And a lot of this is going to be dictated with earnings season. I mean, we're just getting into it, and already we're seeing great numbers. The earnings are great, and I expect they're going to be superb. But we already know that doesn't mean stock prices go higher. Many times we get those pre-earnings runs that I've talked about. We got another one. If I pull up the S&P, let's just pull up the daily chart. But if you pull up the S&P 500 on a daily chart, you'll see that from really right here in June, we were down at about 4160. We ran up to 4400. It's a huge pre-earnings run. Now earnings are starting to come out. Now we're pulling back again. This is not unusual action at all. Very normal for the stock market. If you're not familiar, you should get familiar with it, because the stock market makes much of its moves just prior to the great news coming out with earnings. Then the great news comes out and no one understands why the market doesn't go up. Those who are buying in the know have already bought. So it's leaving retail traders to try to take prices higher, and you're going to need a lot more than just that. Unless you're part of the Reddit group, of course. Sorry. Okay, so let's move on to 10-year Treasury yield. And this is part of the problem. I'll bring up the way I like to use this Treasury yield chart. So here you can see today, again, right now we're down another 8 basis points this morning in the 10-year Treasury yield. The big problem with that is the money is going into the Treasury market, not into the stock market. Every dollar that goes into the Treasury market can't go into the stock market. So anytime the yield's going down, we have to at least consider, while that might be good for valuations in the long term, and especially technology, high growth companies, in the short term, when Treasury yields are going down, money's going into Treasuries. Money's going into the bond market. The other thing you have to consider is that when yields are going down, financials struggle. Industrials tend to struggle. And these are the relative charts of both. And you can see the last 6 or 7 weeks, as yields been going down, so too is the relative strength in financials and industrials. All right, let's move on talking technically. I want to talk a little bit more about this 10-year Treasury yield. And I've talked about this before, so I'm not going to spend a whole lot of time here. But just know that when the 10-year Treasury yield, that's this part of the panel here, here's the 10-year Treasury yield, 10 TNX. When the yield goes up during these periods, when you see the blue shaded area, notice the S&P 500 tends to do pretty well. When the yield goes down, I mean, if you look at these periods, it doesn't mean the market comes down, but it does get a lot more choppy. A lot of choppiness. 2015 and 2016. We didn't go down over the entire period, but there was a lot of choppiness. Prior to 2012, or from the middle of 2011 to the middle of 2012, sideways action, but a lot of choppiness. Look at 2018 through 2020, the pandemic, the trade war. I mean, this was like the poster child of volatility and choppiness, huge moves, two separate cyclical bear markets while yields were falling. So as we're moving higher right now, we have to at least recognize that yields are falling, and that could lead to some of what we have seen before. It's not unusual. It's summertime. Not unusual to see selling in the summertime. So things are lining up, negative divergence, all these things we have to keep in mind. And that's why last week when I was writing Daily Market Report, I was saying, you know what? Some of these signs suggest maybe we need to be a little cautious. If you need another sign, let's take a look at transports. You can see right here, trending lower. If you're familiar with the Dow theory, you know, we got the Dow Jones Industrial Average just set a new high or up at a new high at 35,000. Well, if you follow the Dow theory, you know that transports going to new highs confirms industrials or vice versa. When one goes to a new high and the other goes, that confirms the move. Well, we've got industrial average going higher and, you know, right up against the new high last week. Look at what transports are doing. And it's hard to debate that this is a bearish signal, because transports in a strengthening economy should do very well. Transports should do well. And right now, for the last 9-10 weeks, they're not doing well. 16,000 to 14.5, we're down almost 10% from the high. Now, before you rush out and sell everything you own, keep in mind, we've had a huge move. We're pulling back. Chances are, you know, watch for some sort of reversal in transports. If we get a reversing weekly candle and right back up above the 20-week EMA, that would be a good sign. I mean, you can see back in January, transports took a turn to the downside and then reversed right back up. So, you know, my guess is, looking at all this, my educated guess is that we're going to be choppy. I don't expect a massive sell-off. I wouldn't rule out a 8 to 10% decline in the major indices. I don't think it'll be that bad. I wouldn't rule it out. But I do think this year, even if we had that later this year, we're going to be at all-time highs again. I think the bigger picture long-term signals are still very bullish. Some of the short-term, and I would consider the transports not participating as more of a short-term issue right now. The weekly negative divergence, short-term to maybe even a little bit intermediate term. And when I talk intermediate, I'm starting to talk more than a month. 1 to 3 months, maybe even up to 4 or 5 months. I don't think it'll be that long because we've got the fourth quarter coming. But historically, now until September 26th is not a good period. So that would be the next couple months. And everything's kind of lining up like it's just going to be back and forth. And again, maybe we get a little bit more selling. We'll see. All right, home builders. This is a group I'm watching because yields are falling. And as yields fall, home construction should begin to benefit. Now we're at this double, almost a triple bottom. You can see from the past few months. I'm going to see how this group reacts today at the open. If it gaps down like everything else, it's going to be either at or near a new low. And I'm talking about 4-month low. So if it gaps down and starts rallying back, it could be that we're printing a bottom in the home construction area. Now, if it gaps down and continues to sell off, then we've got a breakdown on our hands. And in the short term, I'm looking at this as a downtrend. Lower low, lower high, lower low, lower high. And then if we break down again, that's continuing this 3-month or 2-month downtrend here. Daily PPO negative. Now we stretch it out, look at the weekly chart, and you see a different picture. Yeah, we've been weak, but my gosh, it's in the midst of a huge, huge move to the upside. Very strong period of price action here. So these are just a couple of the areas I think worth watching. I mean, obviously we want to watch every area of the market, but these are a couple. I think transports in particular, one, when that group starts to turn back and trend higher to the upside, that would be a very good sign, I think, for the market. Until then, I think we probably should be a little cautious. That along with the 10-year Treasury yield. All right. Looking at the FANG stocks real quick, because this group, honestly, is what is holding the market together. It's been worse than what it feels like, or if you're just following the S&P 500, or let's say you just trade the spider or the Qs, you probably are looking at it saying this wasn't bad. I mean, we went back down a little bit here, and well, this is Facebook, but if we pull up the spider and the Q, I mean, spider just had maybe looks like just a day of selling on Friday. The QQQ, a couple of days at the end of last week, but still in this uptrend, doesn't look that bad. And the reason is that they're market cap weighted indexes. So the large cap stocks have tremendous influence. Well, large cap growth stocks have held up the best recently, probably because those rates have dropped so much, and these companies are going to come out with strong earnings. Here's Facebook. I'm going to go through these pretty quickly, but you got Facebook. You got Amazon, which had a breakout. It's gone back down now, trying to test this breakout. This is actually probably not a bad area to jump in if you were not in on Amazon. Apple just broke out to an all-time high. Came down Thursday and Friday. No big deal. Netflix started to gain some traction, but then fell the last 2 days last week pretty good, but testing its 20-day. Google, I mean, this has been a pretty strong performer, barely even budged to the downside last week. And then throw in Microsoft. Microsoft continued to perform very well, hardly any selling last week. So these companies combined are essentially just holding the market up above their shoulders, just kind of, picture some muscle-bound individual just holding everything else up, while everything else around it's been kind of dropping and not really looking very good. So it's a little bit of bifurcation in the market in that sense, in that some of the large cap growth stocks, because they are so heavily weighted in some of our indices, they're holding up really well. Let me show you what's going on in the small cap area. So small caps are now down at about a 3-month low. And if you look at their weekly chart from last week, remember S&P lost about 1%. Small caps lost 4.5%. Mid caps, 3.3%. With weekly PPOs rolling over, failing to hold on to the 20-week moving average on the mid caps. Go back to small caps, we're below the 20 and heading toward the 50. So, and with that really nasty weekly negative divergence, I mean, you can see that the momentum has really fallen out of small and mid cap stocks. And then you look at an area of the market like energy, negative divergence on the weekly chart. We got right up to that 56, 57 level I was talking about from a price resistance standpoint. And we've dropped quite a bit now off of it, 48.68. Do you look at crude oil? Remember, $77 target on crude? We got to 77, now we're at 71.56. And if you look at that 77, look where we went to. Right up here to 76 or so to test that prior high. Now we're rolling back over. Notice crude oil, lower PPO, higher price. A negative divergence there. So we're going to have some patience. There are areas of the market that are just screaming for a period of consolidation, maybe even weakness, but at a minimum, I would think consolidation this summer. We could see rotation back. I mean, like I said, large cap growth starting to get some of the money on a relative basis. Maybe some of these other software companies, smaller cap, maybe they start to, pick up a little bit more momentum. They didn't last week. But maybe, we're starting to see a little bit more rotation back to growth with yields falling. Those are some of the things to look for as we go forward. All right, let's talk a little bit about Max Payne. I mentioned this earlier. Look at NVIDIA. I'm going to just read you a couple of numbers here that we talked about last Tuesday. NVIDIA closed last Tuesday at $810, right up in here. The max Payne, and I said at the time, I wouldn't expect it to hit max Payne, but we look at max Payne as a potential directional move. So if NVIDIA is sitting at 810 and it's got a lower max Payne level, then we would look for the probabilities that NVIDIA would pull back because it would save market makers a lot of money. Well, this could have been a poster child, what we talked about. NVIDIA was 810 last Tuesday after the close when we had our webinar. Max Payne, 719.06. Look at where we finished last week, 726. And if I pull up NVIDIA at the open this morning, 715. Think about that. $100 since last Tuesday's close. I always say that max Payne is not a guarantee, and there are times it doesn't work. And the reason it doesn't work is not because it's not meaningful. It's because market makers, they wouldn't have lost money if NVIDIA didn't come down. But I can promise you they made a killing last week because it did come down. When prices are going up and everybody's buying calls, market makers are selling those calls. And I'm not a market maker, never worked for one, but I'm probably pretty sure that when they sell the call, they buy the stock. Covered call strategy. So if price keeps going up, they're still fine because they own the stock. They lose on that option, but they own the stock. So they're still covering themselves. But when prices go up and they're long on the way up because they're selling calls, what happens if they begin selling their long position and then even go short? Look at the volume pickup last week. I'm not so sure we didn't see market makers jumping on the short side, because what that does is they cashed in their longs, made money, started heavily shorting, made money. And all of those calls that had max Payne at 719, listen to this number. The value of the net in the money calls last Tuesday, the value of those net calls was $785 million. One stock, one July strike price. Well, not strike price, but July expiration day, because it's the monthly options that we look at. July, NVIDIA, max Payne, $785 million of net call premium. And guess what? If you were holding, it's gone. $785 million is gone. Where'd it go? Well, probably the hundreds of market makers right now that line their pockets are counting their money right now. Everybody else, anybody holding those options, poof. I've seen it over and over and over again. That's why we do our max Payne every month. Doesn't mean you're going to see this, but sometimes we do see this. And that's why if I was looking to buy NVIDIA last week and I knew it and I had the knowledge of max Payne, there's no way I would have bought NVIDIA last Tuesday. Zero chance, knowing that market makers had a financial incentive to drive it lower. I think NVIDIA is a great company, and I think it'll probably rebound right back up. Now, what will it rebound today? I don't know. We might go down and hit the 50-day. We might even get this breakout level all the way down to 650. But I can tell you what, the reward to risk is a lot better on NVIDIA today than it was 3 days ago, thanks to max Payne. How about DocuSign? DocuSign had $32 million worth. Look at this last Tuesday. Now came back on Friday, but by Thursday at intraday, it went down to 270. Max Payne we talked about was 260. Almost got there before it bounced. Let's see. Nokia 5. It was 588. Now Max Payne was 473. We didn't go down there, but look, sold off for 3 days, 568. There's only $9 million at stake, but probably 20% of it, maybe a couple $1 million saved. Tesla, $563 million worth of in the money calls net, 3 days down, saved a bunch of money. We were at 678.48. We're 644. And pre-market, I know we're getting ready to open here. Pre-market down 15, so 629. And actually, Max Payne was 641. So 563 million. We only needed to go down 27 bucks, which it did. So Max Payne is pretty important, something that we should be keeping in mind every month. And we have a webinar the Tuesday before the third Friday of every month. Third Friday is always options expiration, monthly options expiration. So check your calendar, third Friday, 3 days prior, Tuesday, we'll have a Max Payne webinar. We'll talk about it. All right, I'm not going to go over a whole lot more. We're going to get ready to wrap this thing up, but let's go in and take a look at, let's see, what else do we want to talk about today? Well, let's just do a couple earnings and we'll wrap up today. So one company reported this morning, AutoNation, talk about a blowout, $4.83. Market was expecting $2.85. $4.83 versus $2.85. Get an update here and see what it's doing. It's up a buck, but a lot of it, I guess, maybe market's already, hey, we've priced it in. We're near 52-week all-time high. So it's priced in. If we don't get that breakout today with volume, I'd be a little careful with AutoNation in the near term. Might be more sideways consolidation we have to deal with. Keep in mind, October of last year, even before that, September, this was a $50 stock. We were just over 105. So the stocks run a lot. May continue to consolidate. We'll see. Tractor Supply expected to earn $2.94. It earned $3.19. Stock down 6%. Sometimes the correlation between what you see in an earnings report and what you see on a chart, if you're not a technician, you haven't followed the market, you don't know how it operates. That's why I say going into earnings, I can generally tell you whether or not a company is going to have a good report. But what I can't tell you is how the market's going to react to it. You can have a blowout report and the stock's down 12%. Or you could have a report that comes in break even, kind of not very good, and the stock's up 10%. The market reaction, that's why, to me, the riskiest time to own a stock is heading into its earnings report. And you can see that with Tractor Supply. Now, 170, 172, I would expect would hold on the stock. If we get a breakdown on a close below that level, I'd grow a little bit more pessimistic on TSCO. But otherwise, I think it looks pretty good here. Well, when I say pretty good, I don't mean pretty good because we are obviously down 6%. I mean pretty good from a longer term perspective, up, sideways consolidating. And I think it's still, from a longer term picture, okay. The last one I'll bring up is PLD. They reported $1.01 versus 99 cents. Had a false breakout on Friday. It's going down today. I wouldn't be surprised to see a 20-day test here at a minimum. IBM reports tonight. So let's look at that chart. How about the three you must see? I'll pull three stocks are going to report earnings tonight. How's that? So IBM continuing to trade down. It's got what I would consider very strong support around 135. That's where we had the volume pick up and the gap up. That was its April earnings. It made a run. It's pulled all the way back. Still AD line not looking very good. So IBM, I'm still cautious about. I mean, we could look at a 10-year chart. This stock has gone nowhere. Just not a big fan. JBHT, JB Hunt Transports. This is going to be a big report because transports have not been doing well. Are we going to find out why from JB Hunt? I don't know. We're going to find out later today when they report. But they had a nice uptrend, pulled back, established a low, trying to move back to the upside, but today a little bit weak. I'd be a little cautious heading into this report as well. And let's see, last one we'll do. How about STLD? Steel Dynamics, they report. I see sideways consolidation. I think we're testing one key area of support at 57.50. The other one was the breakout above 52.50. We haven't gone back down to test that level. So if we can't hold 57.50, next up would be 52.50. Watch the earnings, because if we don't get a positive reaction, that could be the catalyst to drive it back down, or could be the catalyst to get us to move back up toward the upside. It's really, at this point, looking at the chart, I think it's a coin flip. I do like the AD line better at the most recent high. You can see the AD line was high as well. So I do like it better than the other two we just talked about, but need to hold that 57.50 level. All right, that is it. Quick update on the market. We're 5 minutes in. And right now we've got the Dow Jones down 465, S&P down 54, NASDAQ now down 1.36%, down 196. Again, what I would just suggest to everybody, it's July. It's mid-July. Forget about go away in May. They should have a different saying, go away after July 17th. I know it doesn't rhyme, but if I was going to say go away, that would be the period. And I wouldn't go away, but this is the most challenging period seasonally throughout the entire year. July 17th close. 16th this year. 17th was Saturday. July 16th close to September 26th close. So let's be careful here in the near term. Let's get through this bridge or whatever, move to the fourth quarter, which in my opinion is going to be a very, very strong quarter ahead. Let's see what happens here, but stay safe, stay cautious, and we'll get through this. Everybody have a great day. Happy trading.